There's a guy sitting in his basement right now wearing a 3-day-old t-shirt, scrolling through Reddit while eating cereal for dinner, and somehow this complete amateur just outperformed Goldman Sachs by 40% this year. Meanwhile, there's a Harvard MBA with a corner office on Wall Street who spent 6 figures on advanced analytics software, has access to private research reports that cost more than your car, and employs a team of quantitative analysts with PhDs in mathematics, and he's getting absolutely demolished by the serial guy. This isn't some feel-good fairy tale or a one-off lucky break. This is a pattern that repeats itself over and over again in financial markets. The so-called dumb money consistently embarrasses the smart money, and it drives the suits on Wall Street absolutely insane. Because everything they were taught in business school says this shouldn't be possible. All those fancy models and sophisticated algorithms should give them an unbeatable advantage. But here's the thing about markets. They don't care about your degree or your pedigree or how much you spent on that Bloomberg terminal. The retail investor revolution isn't just some internet meme that got out of hand. It's a fundamental shift that's exposing some uncomfortable truths about how investing actually works. And the more you dig into why this keeps happening, the more you realize that being smart might actually be the problem, not the solution. Let me paint you a picture of what smart money looks like in action. Picture a conference room on the 40th floor of a Manhattan skyscraper. There are 12 people around a mahogany table, each one holding multiple advanced degrees and managing billions of dollars. They're analyzing market trends using proprietary models that cost millions to develop. They have direct lines to company executives, access to earnings calls before they're public, and research teams that can dissect any investment opportunity down to the molecular level. These people eat, sleep, and breathe financial markets. They've memorized every economic indicator, can recite historical market patterns from memory, and understand complex derivatives that would make your head spin. When they make investment decisions, it's based on hundreds of hours of research, sophisticated risk management protocols, and decades of combined experience. Now picture the dumb money. It's Sarah from accounting who just opened a brokerage account last month. She's buying stocks based on companies she actually uses and likes. Maybe she noticed that everyone at her gym switched to a new protein powder brand, so she bought some shares. Or she saw that her teenage daughter and all her friends were obsessed with a particular app, so she figured the company might be worth investing in. Sarah doesn't know what a price-to-earnings ratio is. She's never heard of discounted cash flow analysis. She couldn't tell you the difference between EBITDA and EBITDAC if her life depended on it. Her investment strategy consists of buying things that make sense to her and holding on to them because she forgot to check her account for 6 months. And yet, somehow, Sarah's random stock picks are crushing the sophisticated hedge fund's carefully calculated moves. The Harvard MBAs are scratching their heads while the person who learned about investing from TikTok videos is buying a new car with her gains. This phenomenon has been documented for decades, but it's become impossible to ignore in recent years. Study after study shows that amateur investors frequently outperform professional money managers. The numbers are so consistent that they've become an embarrassment to the entire financial industry. We're talking about people with no formal training regularly beating professionals who've dedicated their entire careers to this stuff. But here's where it gets really interesting. The reasons why dumb money beats smart money aren't what you'd expect. It's not because amateurs are secretly geniuses, or because they're just getting lucky. The truth is far more fascinating and reveals some fundamental flaws in how smart money operates. These flaws are so ingrained in professional investing culture that most Wall Street veterans can't even see them anymore. The amateur investors aren't winning despite their lack of sophistication. They're winning because of it. And understanding why this happens will completely change how you think about investing, markets, and what it really means to be smart with your money. Money. The first major advantage that dumb money has over smart money is something that sounds completely backwards: ignorance. While the professionals are drowning in information, the amateurs are operating with blissful simplicity. And in a world where too much information can be paralyzing, sometimes knowing less is actually knowing more. Professional investors suffer from what psychologists call analysis paralysis. They have access to so much data, so many reports, and so many conflicting opinions that they end up overthinking every single decision. They'll spend weeks analyzing a stock from every conceivable angle, building complex models, stress testing scenarios, and by the time they're ready to pull the trigger, the opportunity has already sailed past them. Meanwhile, the amateur investor sees a company they like, thinks it makes sense, and buys it that afternoon. No committee meetings, no risk assessments, no waiting for the quarterly earnings projections. Just pure, simple action based on gut instinct and basic logic. But here's the kicker. That gut instinct is often more accurate than all the sophisticated analysis in the world. Because markets aren't actually rational. They're driven by human emotion, crowd psychology, and trends that can't be captured in a spreadsheet. The amateur who notices that everyone in their neighborhood is suddenly shopping at a particular store might be picking up on a trend that won't show up in the professional analysis for months. The second advantage is even more counterintuitive. Professional investors are absolutely terrible at timing. They're constantly trying to be clever, buying low and selling high, jumping in and out of positions based on short-term market movements. They're playing a game of musical chairs where everyone's trying to be the smartest person in the room. Amateur investors accidentally stumble into the greatest investment strategy of all time. They buy and forget, not because they're strategically brilliant, but because they're busy living their lives. They don't have time to check their portfolio every 5 minutes or panic when the market drops. They buy a stock and then get distracted by their actual job, their family, or whatever Netflix series they're binge-watching. So the next time some Wall Street hotshot tries to convince you that investing is too complicated for regular people, remember Sarah from accounting and her protein powder stock picks. Remember that sometimes the smartest move is admitting you don't know everything. Because in a game where overthinking kills profits and simplicity wins fortunes, maybe being dumb money isn't so dumb after all.